Good afternoon, everyone. I warmly welcome all of you to this call of Hemas Holdings PLC for the quarter ended 31st March 2023. Today in the call, we have our Group CEO, Kasturi Chelaraja Wilson, Group CFO, Zami Pasir, Director Group Finance and Treasury, Hazel Pereira, and Head of Sustainability and Corporate Communications, Ishani Ranasinghe. During the call, Hazel will be discussing the macroeconomic challenges and how we were impacted by them. And we will be giving an update on the strategic pillars, strategic incentives, and sector-wise performance. Zami will take us through the financial highlights and an ESG update by Ishani, followed by a Q&A session. Hazel, over to you.
Thanks, Gulshi. So moving on to the macroeconomic update, we did see a surge in inflation where CCPI and NCPI did have approximately around 50% growth in comparison to last year. So this did have an effect on the consumers' purchasing power, and we did see volume contractions across all the businesses. And there was a higher impact in terms of non-essential categories, especially in terms of Atlas, where there was a higher drop in percentage of color products, as well as in pharma, where we did see a higher percentage drop in terms of vitamins. We also did see that the consumers were buying in smaller quantities, and there was high skewness towards affordable options in terms of discounts, promotions, and also budget packs. The other parameter that affected our performance was the depreciation. In comparison to the 200 that was experienced last year, the rates were, the USD LKR was around 370, which has now come down to around 320 and 300 ranges. So Hemas, being a primarily highly import-oriented entity, was highly affected by the depreciation. And also there was an indirect impact because of fuel increases and so forth, where the overhead costs also did see an increase. Moving on to global commodity prices, the global commodity prices did see a declining momentum in the last quarter. And accordingly, the benefit of same has been passed down to the consumers. And we did see that price adjustments were made in the portfolio. Moving on to interest rates, we did see that year on year, the interest rates have increased by around 13%. And we did also see that the group's working capital base, due to supply chain restrictions and inflationary impact, the base did increase. And on top of that, with the interest rate increase, the group's performance had a significant impact, which will be touched upon by Zami during the financial performance review. So tax reforms also affected the business and the consumer alike, which again will be touched by Zami in his performance. So Kasturi, over to you.
Good afternoon, everyone. I'd also like to introduce in the room Moise, who is our CFO, who takes over on the 1st of June, and Zalmi, who has been our CFO and been my right hand for the last 3 years, would be moving on from Hemas from the next quarter. So when I look back at a year and a quarter, why how Hemas has performed and has come out stronger, where I say it's because of a few things. We were clear of what our strategy was, but more importantly, I think during challenging times, companies which had good governance frameworks come out stronger. We've also got the leadership team, which is experienced and diverse, which I think is a hallmark of Hemas. And of course, the fact that we had a strong balance sheet, which helped us to actually leverage on that when the need arose for us. So overall, if you look at the businesses in this context, when I embark and you do, I think you must have tired of hearing the 4 pillars. It hasn't changed. It's the core, the new and adjacencies from the core, the international as well as the efficiency part of it. And how do I measure on all four of these from the group perspective. Core, we've been strong. We've grown share in each of the main categories and businesses. So every business has achieved the highest share they've ever experienced in a history of Hemas context. And then the new and adjacencies, well, we've been flat as a percentage of total revenue, so we are still at 7% or 6.5%. But that's purely because the core grew so much faster and the devaluation, the rupee value increased. So, but a year-on-year growth is significant. We've had significant growth on that. On international, we've had on the non-Bangladesh, we've had a 60% year-on-year growth. Bangladesh, on with the devaluation of the taka, it kind of has a flat year and a bit of ND growth as well. Efficiencies, I measured, we can measure it from the increase in the OP margin. And then that will be, all these four will be continued as priorities going forward. So if you look at home and personal care, we've kind of built our core, which in our priority areas, we've seen revenue grow, in the consumer business. It has taken a bigger share of the group portfolio in terms of revenue as well as earnings. We've seen the businesses see contraction right across in terms of volume. However, and that's reflective of the market contraction, but however, our contraction, in spite of that, we've seen our market share growth. So I think there the lesson learned is our products. We've seen a huge amount of shift in terms of coming out with value for money products. One example is Air. Air, you recall, we came with the low-cost sandbag, but we moved it one step further into a sachet sandbag. So which meant that people's disposable income actually started deteriorating. So our market share increase was a reflection of the strength of the brands. We did see commodity prices starting to abate towards the fourth quarter, and that coupled with the rupee appreciating, saw the consumer businesses going in with price revisions downward, which for now we'll see. We haven't seen the volume increase to that effect. We don't see the uptake in terms of consumption, but there is a reflection in terms of price revision downwards. The quarter one upsurge for the quarter is that Atlas had its season this quarter in the fourth quarter, and that had and they being the market leader had a quite a great quarter, I must say, and a great year. They came out really strong, especially in the books category and the color categories. In Bangladesh in general, I would say that we had a tough year. What we saw, it was a delayed impact for us because Sri Lanka was going through crisis. Bangladesh had its own crisis with the taka devaluing, which then had with them having import restrictions, as well as fuel being at a high rate. What did it mean from a consumer point of view? We did see consumers absolutely sensitive to any price revision. And out of our portfolio, and just to lay context here, our portfolio now has 3 products, two in the hair category and one in the personal wash category. So the premium product in the hair category took a volume decrease. That is Kumarika, which is our anchor product. But what we did see picking up was Eva, and what we saw doing extremely well was our soap Acticel. They both started tracking on the market share index there, and remember they are just 2-year-old brands. So from a portfolio point of view, the revenue from the new products has moved to about 20% of the revenue in Bangladesh, but we're still concerned on Kumarika. What we've now strategically moved is we've moved for lower value for money pack sizes to make sure that the product is still relevant to the consumer. If I go to the healthcare side of it, so healthcare has been always the majority of our revenue came from healthcare. this year we did see the first time market contraction in terms of volumes in the pharmaceutical industry. The fourth quarter saw a lower decrease in terms of market contractions, but it still is contracting. Hemas the pharmaceutical businesses of the group did see a pickup in the fourth quarter. The first two quarters, we did see a drop of a contraction in terms of volume, but it was way lower than the market contraction. But we did see a pickup in the fourth quarter. What I think we did really well in the fourth quarter is our own brand in terms of Morrison. They started picking up, and Infomore is actually picked up as the highest in terms of volume and second highest in terms of value in that molecule category in Sri Lanka. So it told us two things. It told us if you pick up the right molecule in the right space, which has a growth potential, and you get your quality right, and you get your pricing right, you can get your demand. So we try to replicate that model, but that showed that that was success there. The hospitals had a challenge. The year was tough with them feeling the impact of the consumers' affordability. However, being hospitals in the regional or its outskirts of Colombo, semi-urban population, we kind of yet retained our footfall. What we saw dropping was the conversion to elective surgeries. And I guess where we see this correlating on the other side is that the surgeries or hospital admissions for surgeries in the public sector seem to have taken an increase. However, the positive side for us is our occupancies have remained high. And our core focus areas, which we've done, which is seen as, we chose maternity, urology, ortho, those areas have seen significant growth, as well as consumers seem to have, or patients seem to have appreciation of these four spaces. So those centers of excellence seem to have picked up. So we'll continue to invest in that. We'll continue to invest in the new spaces there with in the IVF, as well as expanding our renal care, which seems to be a need of the hour in Sri Lanka. That has happened. In the mobility, so overall, in the new spaces of the healthcare, it will be the Morrison focus, and making sure we increase our capacity as well, capacity utilization, and the number of new molecules coming in. In terms of mobility, that's a mixed bag for us. We did see from a country perspective, the maritime side of Sri Lanka's relevance as a hub for feedering or for redistribution seem to have reduced. How much of it is within our control, or somehow how much of it is because of the global contraction in terms of demand for goods in general, is something we need to see. But it's concerning from a country perspective that volumes in the port of Colombo has decreased. So from a maritime side of it, while the yields were high due to the dollar being stronger in the first half or first 9 months, I think from volume side, it was not what we expected. However, it was compensated from the aviation side. Aviation, the first half saw both passenger and cargo doing well. Second half saw cargo volumes, which is reflected in terms of our exports of the country, kind of dropping, but we saw passenger numbers as well as yields yet remaining high. So it was a mixed year of two halves, I guess, but it's still relevant and resilient. Maritime is concerning not from a business perspective for me, but it's more from a country perspective, because I firmly always believe that that's one industry the country should leverage on. So basically, these are the business highlights for us. And we'll go to the financial snapshot, which Zalmi would take, and I'll take the outlook later.
Hi, everybody. Good afternoon, and thank you for joining us on our call. The year was a good year for us. We closed it, although we closed it flat in terms of earnings when we compared to last year. We saw growth in both at revenue level and also at EBIT level, as Kasturi described a little earlier. Revenue growth was mostly driven by price adjustments, which was actually for compensating for escalation in costs, both in terms of the devaluation of the LKR, increased commodity prices, and also finance and taxes coming in the segment. We also saw that the margins at GP, although we saw it improving, was eaten out when we came at net profit level. Finance costs saw 8 times increase during the year, both because of the increased interest rates and also the increased working capital base. As you probably are aware, the country went through a lot of turmoil in the banking sector, where we were not allowed, or we didn't have the opportunity to open LCs on deferred terms, where we would get from some customers 90 to 180 days and sometimes even 270 days. But instead we had to curtail that and bring it down to 30 days, or sometimes even pay up on site or even in advance. But thankfully, we hope we are seeing all that behind us now, and the way forward looks much better. We have been able to claw back the credit periods that we used to enjoy with us in the past. Even though we increased our borrowings to fund the working capital, we had excess cash reserves. So from a net gearing perspective, we remained around the 12% level. Quarter to quarter net gearing has improved significantly from 25% to 12%, as I said earlier. In the quarters to come, working capital pressure is likely to subdue as we have renegotiated with our suppliers and continue to work on optimum levels of working capital. I can move to the EPS. As you probably can see on this graph, it's a very interesting chart that shows, especially if you look at the chart on the left-hand side of the screen, we had earnings of approximately 7 rupees per share in FY22, which was around the same numbers that we're reporting at FY23. This is despite driving the operating profit up by about 7 rupees a share, and you can see most of it was eaten off by the increased taxes, about 1.5 rupees there, and about 5 rupees and 15 cents out from the cost of finance. If we carve out the reasons for the cost of finance, you could see that about 4 rupees or thereabouts was driven mostly because of the rate of interest. I'm sorry, the rate of interest, yeah. And the base increase was only just 7 cents. We can probably extrapolate and say that once we start seeing those interest rates going down, we should see a significant favorable impact coming into our EPS. I think that's about it. I'll pass it on to Ishani now to take us through the most important section of this presentation on ESG.
Thank you, Zalmi, and good afternoon, everyone. So during the year, we continued our focus on facilitating the collection of plastic that is sent to the market in terms of in consumer waste. So we were the first corporate to partner with Clean Ocean Force, and we started operating in Jaffna to clear out the waterways and to ensure that we tackle the marine pollution there. So to date, we have collected about 45,000 kilograms of plastic across all our operations. At the moment, we have about 10 locations where we do beach caretaker projects, as well as 1 ocean strainer project. Then during the year, we continued looking at supporting our vulnerable communities, and also building a social safety net remained a priority for us. So one of the things we did in terms of our Hemas Outreach Foundation was to open our 62nd preschool in Colombo, Vanathamula area, which is a very underserved community. So this is the first preschool that we have opened in Colombo. Then another initiative we wanted to tackle was malnutrition. So we partnered up with Sri Lanka College of Pediatrician. For 150 families, we will be donating dry rations in Anuradhapura for a period of 6 months. Another focus area for us was how do we give access to affordable medicine. And one of our important stakeholders was our employees. So Morrison offered free medicine for all their employees to treat diabetes and cardiovascular diseases because Morrison branded medicine that was offered. Another focus area for us was how do we give, focusing on giving economic empowerment and access to economic independence for women in the communities we operate. One of the first projects we launched was Diva Data, where we focused on providing training, guidance, skills, and needed resources for female entrepreneurs to ensure that they have this economic independence. Then another program we are piloting is where we have a women's sales force for our general trade. And this is a pilot project. And depending on the success, we will be scaling it up. So I think I'm going to pass this back on to Kasuri.
Yeah. So for me, like Zami said, yes, she is a favorite because we can see how as Hemas we can impact society around. You can see two new things, which is the feed a child. Why we say 6 months, the objective here is the same family gets 6 months of food. The kids are ultra malnourished. So they are, I'm not sure from investor point, but it's important from a Sri Lankan point, we've got the number of kids who have moved into the ultra malnourished basket has increased. So the weight, and they give us indications that these kids who are weighed at the beginning after 6 months have received progress, we would commit to do this program at home. And the second one is economic independence of, and that's the DVR. On Salesforce, the commitment is if we can support women who are not economically independent to earn, say, 30,000 rupees a month as net income through a support program where we also get impacted with revenue growth. I think that's a program we would look at. It's been piloted, if it works. I think as a corporate, while we grow and we deliver shareholder value, given the context of what the country is going through, we should be able to help society be uplifted economically. So that's the two thought processes on that. So on the focus area and the outlook for the next year and maybe the short term. So first thing is we'll continue to do the 4 areas. The 4 has to be more relevant. We invest and grow the new spaces. We have new products we have launched. And especially the areas of in the consumer space, it was beauty and the male grooming side. And in Atlas, we actually will be investing more on the international space. They've started working with global franchises. We've sent a couple of shipments out there. And the success will be if we can get more from the same region or expand the same franchise to different regions. It's a test for us. As you know, we've been almost very domestically oriented. So those are 4 focus areas for us. Doing more with the new products as well as international. Working capital would be a focus for me, but particularly because how do you shave off interest costs and how do you get back your working capital cycle? Pharma predominantly, if we had to take a call during the year to give access trumped margin at that point, because it came to a point that we didn't have foreign currency, our terms of credit was different. So we kind of had to forward that. And then we had to store inventory at a higher interest cost. So that impact is what we took in last year, but it was done with the decision that these are critical medicines. If we do not bring that in, we do not give access to the patients. It was kind of responsibility, and we did that. So this year we're going to focus on the working capital as well. And one big ticket item would be talent. I guess as country sees a lot of attrition, this will be something we as a group will focus on, our young leaders. You see across the room, I think Zalmi and I did the age barrier here, but rest of them are keeping us in a decent number. So those would be key areas. In the medium term, acquisitions in the consumer business is something we are going to focus on, particularly in the niche categories we would be wanting to enter. And Morrison focus on developing a Sri Lankan branded generic would be something we'll be wanting to make it work. So those are kind of my areas of focus. Yes, and I'll be opening it up for questions, but before I do that, I'd just like to thank everybody who's on the call. I'll take up your questions after that.
Kasturi, we have a question. It reads, what is the current capacity utilization of the Hemas plant?
So we've, I think we crossed about 9 to 10% in the last quarter. It has its ups and downs. The days we get a buyback, we cross at 10%, but generally we are between 8 and 10%. Any others?
So there's one more question, Kasturi, it reads, how do you expect commodity prices to come down further, and will there be further price reductions?
So the pricing has two drivers. One is the commodity price, other is our exchange rate. On commodity price, I don't think it's going to come down further. We've seen most of them at quite low levels compared to last year. However, and those price reductions have been passed through. We need to see what you would see is the rupee appreciation impact on that. So based on that, there would be some price revisions. But if it's sustainable, we'll have to see. So what we will see is price revisions only on the rupee impact. The inflationary impact has to also adjust and settle down.
I think Asanka has a question for us. Asanka, over to you. See the screen. Hi, Asanka.
Hi, thanks, Kasturi, for the call. Kasturi, I think during the call you mentioned that in terms of consumption, you are yet to see an uptick. I would like to dig a little bit deep there and get a bit more clarity. So if you look at now about 5 months of the year has passed and the taxes came into effect late last year. So if you just look at the run rate of consumption or the momentum in consumption across the 5 months, are you not seeing any kind of improvement at all in terms of volumes, not in terms of value?
Okay, so overall, generally, we see a slowdown on degrowth, which means there is degrowth of volume. But where I think there is an increase in volume is in the general trade that's on the rural side. People are, I think, during the height of inflation, they started feeling that they made choices, and now they are having a bit of leeway of adjusting to the inflation. And maybe that's in the backdrop of a good harvest as well. So we see a general trade slight pickup on volume. But we see a big drop in the modern trade format. So I am presuming, and overall, so we still see a negative. And I guess you can translate that into the impact of tax in the last quarter. So you're talking about the middle income consumer feeling the impact of all that. And maybe the fact that the moratoriums have been lifted from some of those industries, I'm not sure, but we don't see, Asanga, to your question, the only uptick we see is from a general trade, non-urban side of it.
So actually, I'd relate to your answer. It's probably, there can be a hypothesis that taxes mainly impacted by and large the modern trade or the urban crowd, and that's why it continues to be negative, while better crop, etc. means the general trade might be seeing a pickup. Is that the kind of belief?
I think think so. So if you, I don't know, I do the sense check only on my market visits. So the market visit shows that it's not so dull out in the general trade. And I correlate it from the volumes we get from the general trade. The assumptions I'm making is maybe it is just that they have got a bit more, it's not, the consumers are different, right? They don't spend, their cost of living index is way lower
Yes.
than an urban citizen from the rent to the way they use the fuel and electricity and stuff like that. So I guess now with their industry is doing well. If you do southern belt, cinnamon people are doing well. Fisheries is okay now. You've got agri doing okay. So I guess it's something to do with their disposable income taking a slight increase. That's our kind of consumer. And North has been always resilient to any shock. We didn't see a drop from our products. We're quite strong in the North. So they've always been resilient to anything. That's purely because of the diaspora revenue coming in. Having said that, what we need to be cautious here is there is still quite a bit of kids who are not having proper meals in the school. And why is that relevant? It's just that the index that something is going wrong in one segment may necessarily not be our consumer. But will that trickle back into our consumer segment is a question we'll have to see in the next quarter.
Right. Thank you, Kasturi, for that. I have a few more questions, but I'll take a break while you answer the questions from others. Thank you.
Okay. Thanks, Asantha. Kasturi, we have 2 more questions. I'll post it since it's all relating to Bangladesh. First question is, how about the competition in Bangladesh? And the second question, with regard to that, the same lines reads as, how are the margins in Bangladesh segment affected by the economic conditions?
Yeah. So the first question, competition in Bangladesh. Well, with inflation and what the country was going through, the Bangladesh market kind of consolidated. What I mean by that is the strong 4 or 5 brands get chosen to be put on the shelf. So how the retail trade works is the shop guy there will have X amount only, and he will allocate more for food than the personal care, which is they call discretionary. So in competition wise, where we saw was the stronger brand stood, and both are, and the good news is there's one big strong brand there, Marico is big there, and they were strong, and both our products actually went back into the basket. So it still showed a certain equity level. It was a strong product. Where we saw the shift is they were moving from premium and going into value for money base level product. So that we saw on the hair side. On the soap, what really did well was our soap was positioned as a value for money product, and it really took off as in that positioning place. So that still we feel that again the premium soaps are struggling and the value for money products are doing well. Kumarika was in a premium point. So on that, what about the margins? So well, it did have, Kumarika had an impact because of the cost of imports and the devaluation of the Dhaka, but it had a double impact because the volumes also decreased. The rest of it, the margins are protected. What is good was, I guess, the competition on the soap segment actually did higher price increases than us. So we gave us on a price parity, we could actually move our product a bit, and that improved our margin profile as a entity there.
Thank you, Kasturi. There's one more question. It reads, are there any expansion plans for the learning segment?
So the learning segment has always, for the last 1 year, it has been looking at expanding. So one thing is expand in terms of markets geographically. So today our learning our products are there in Bangladesh, it is there in Pakistan, it is there in the Middle East. We are and this year we'll be going deeper into those with a different range of more ranges of products. And this venturing out, we realized that Sri Lanka has very poor FTAs other than India with any other regional country. I think intra-regional trade is so low in this region. Actually, we have better agreements with European countries. So that is one geographical side of it. The other side is the segment side of it. So we've moved into EduToys in another geography, not in Sri Lanka. We franchise it to a big educational learning franchise. If it works, what we're learning from them is the technology, the new kind of design and how it relates to each consumer and kid. If it works, we would see whether it can be lifted and shifted into Sri Lanka. And as I think it's on your pack, we went on the learning platform. That's not a separate segment. It is part of our core. How do you engage with our consumer closer, and how do you offer them more learning experience other than product as well? That is still on, and it has seen early signs of success, but it is not going to be a different segment for revenue generation purposes.
Thank you, Kasturi. Zami, there's a question. It reads, can you shed some light on the recent increase in the long-term debt position of the group?
Thank you very much. The long-term debt position of the group is mostly related to the loan that the group took to fund its plant, the pharmaceutical manufacturing plant in Pitipana, Pomagama. And that, if I remember right, the terms were a 6-year loan at a fixed rate. Thankfully, we managed to negotiate and get a fairly good rate at that time, for which we're getting the current benefits at. I hope that covered the question.
Thank you, Pan. So there's one more question, Kasturi, to you. It reads, to give us an update on the buyback, as well as to whether on government paybacks and so payments from the government.
I'll answer the second part first. I think both pharma, whether it's manufacturing imports, the government owed the industry quite a bit of money, but we were given billion of treasury bonds, and which have been liquidated, and we realized our dues. We've told there is also another segment, the next tranche they're supposed to solve for the country, for the industry, which hopefully happen. So from the buyback, look, we can't control how the government does business. We can request and we urge them to actually honor the contract, but we have put our energy into creating products in the private market. And that's where we're seeing success. However, we've seen that within the government manufacturing, companies where our volumes were taken and given, got the allocation from our volumes, haven't been able to supply or haven't been able to have some quality issues. So in that light, government has been reaching out to us to secure some urgent orders from the old buyback, and which we have honored, but we've honored it on our terms of the cost structures are different now, so we've been doing it on our terms. We will be engaging to see whether the newer molecules can be procured from us, and if they do need it, we would supply it. But I'm very cautious that we've been bitten once with the buyback, and if they do want it, we are willing to supply to the country and the patients, but it will be done on the terms we are willing to do it.
There's one more question, Kasturi. This is with regard to the hospitals. It's reading, what are the current occupancy levels at hospitals?
Both are on the high 90s currently. I think Talat is a bit higher than Bangladesh. Both are very well. Yeah. So these occupancies are maybe because you must be knowing we've got a whole load of flus and medical bunks going about. So some of these are medical conditions. On surgical, we are still averaging the same. We have not dropped, but we've not seen the upsurge is not due to surgical, the upsurge is due to medical patients.
There's another question. It reads, how does the palm oil price affect the margins? And are we importing or is it locally produced?
You can answer that, right?
Yeah, palm oil prices have sort of stabilized and in fact, they're starting to see it go down a bit. Sadly, we don't use the locally produced palm oil because it's not fit for purpose for our product. The subsidiary anyway, Hemas Manufacturing is exploring all the options to see whether we can come up in a way that we could use the locally produced palm oil. But at this stage, no, we don't use the local.
So this was a question asked to us, why don't we locally source? We had a quality issue and then a safety issue. So when you're in consumer care, you need to make sure you adhere to the safety standards we set ourselves up for. So that is why we need to continue to involve. Asanta had some more questions, Asanta?
Can you guys hear me?
Now you can,
Yes.
now you can, yeah.
I don't want to leave Zalmi out in his last investor call.
So give me one as a parent.
So Zalmi, fair question for you. If you look at the financing cost or the borrowing rates you guys are facing as of now, we speak, what kind of a decline versus the last quarter you guys are seeing?
Something significant because see, like I said earlier, we saw our borrowing base going up purely to fund the deficit we had in trade payables, where we were previously getting it interest free from the supplier's credit. But in the first, second, and probably a little part into the third quarter, we didn't get that, mostly because the banks were not able to give us the lines that we needed. Now, thankfully, we have seen a turnaround, and probably Hazel can confirm that, where we have started seeing the LCs being opened out even to 180 days if needed. And that obviously then releases a lot of pressure in terms of using debt to fund the trade payables. Coupled with, we were previously borrowing, as you know, in the 30s, where we saw WPLR going to those skyrocketed numbers, and now we started seeing that coming down. So the benefit of that also has started coming to play, and we've seen a fairly good portion of it coming in the fourth quarter. My gut feeling is that the coming year should be good unless we see something very much untoward happening. Destabilization in the country or something like that. But if things remain sort of stable the way they are, we would see that the finance cost compressing very significantly and supporting the group's results in FY24.
Thanks a lot, Zalmi, and thank you very much for the help over the years. I'll probably harass Moise from next quarter onwards. Thank you, guys.
Thanks, Asanga.
Thanks, Asanga.
Kasturi, there's one more question we have got. It reads, what categories saw the biggest hit on volumes in the FMCG segment, and how do you plan to navigate this challenge?
So the volume big drop was on the home care side of it. Purely, one was we had challenges in our supply chain. We saw the consumers shifting for low price point value for money products. So it took now we've got alternate strategies in place in terms of newer options. But that was where we saw relatively compared to the rest, that was the volume drop. The second volume drop we did see, with what we see picking up is the soap category. We saw that dropping in the first two quarters, second and third quarter, but now it has picked up. So I guess the home care was the main place where we did see a volume drop, not on the personal care.
Thank you, Kasturi. I guess we can answer a few more questions that have come in here. It reads, what products are produced predominantly in the Morrison plant, and are there any plans to expand the portfolio?
the products in the Morrison plant, the new plant.
Yes.
So the new plant is actually allocated, it's a tablet plant. So currently, all our branded own products come out of that, whether it's a diabetic space, the hypertension space, or the cardiac space. We also do our paracetamol from there, paracetamol, which is a private market product as well as a government supply product. New plant would take most of all of our branded generics in, purely because these branded generics, to compete at the quality of any imported product has to come out of this plant. What the other plant does is more the consumer health side of it, which are lotions and the liquid side of it is remaining there.
We could also open the floor if anyone has any questions.
Okay. Thanks, everyone. So looking forward to the next quarter. And I'd like to thank Zalmi for sitting on this every quarter. And when I was with my training wheels on, it was Zalmi who was there. And looking forward to Moise taking it over from next quarter. Thanks, everyone.